The U.S. stock market is closed for the weekend, with the last closing price for Apple Inc. at $234.07, marking a gain of 1.76% from the previous session's close on Friday, September 12, 2025. This closing price reflects a surprising rebound after a week of volatility and disappointing news. While the general consensus among investors was a sell the news reaction following the recent iPhone event, the stock's ability to not only stabilize but close higher suggests a powerful underlying dynamic at play that most of the market is completely missing. The immediate expectation was that the lackluster reception to the new iPhone 17 lineup, which analysts largely viewed as an incremental update rather than a revolutionary leap, would punish the stock. Yet reality showed a different story. The stock price, rather than cratering, absorbed the initial hit and found a floor, indicating that institutional money and savvy retail investors are looking past the superficial product cycle news and focusing on a much bigger, long-term narrative that a lot of self-investing and individual brokerage accounts are overlooking. This isn't about just one product launch. It's about the strategic shift and silent strength of the entire ecosystem. The recent intraday movement has been a textbook example of this tension between expectation and reality. Following the iPhone event, there was an initial dip, driven by the immediate emotional reaction of the market. Trading volume spiked as short-term traders and those using platforms like Robinhood stock trading sold off, expecting a protracted decline. However, the sell-off was met with significant buying pressure, pushing the stock from its intraday low of $229.02 back up to a high of $234.51. This is a classic case of smart money stepping in to accumulate shares on weakness, understanding that the narrative of a single product cycle is only one piece of a much larger puzzle. The real story isn't the hardware, it's the services, the brand, and the sheer inertia of Apple's walled garden. When you look at the raw numbers, the market's reaction seems almost irrational. Apple took a $1 billion tariff hit on its new iPhones, yet chose to absorb the cost rather than pass it on to consumers. The conventional expectation is that this would squeeze margins and hurt profitability. But what if this move is a long-term play to solidify market share in crucial regions like India and China, where price sensitivity is high? It's a strategic sacrifice of short-term margin for long-term dominance, a move that only a company with Apple's immense financial fortitude can make. A lot of online investing advice would focus on the immediate margin compression, but the reality is this is a power move. Beyond the daily swings and the noise, institutional activity tells a more compelling tale. Despite a few funds reducing their positions, the overall trend from large institutional investors filing their 13F forms indicates a continued, albeit cautious, accumulation of Apple stock. Funds and wealth management services from Fidelity Investments to Interactive Brokers Trading are not abandoning the stock. They are analyzing the core fundamentals, the company's robust balance sheet, its massive cash reserves, and the relentless growth of its services segment. They understand that a single iPhone launch doesn't define the company's trajectory. What truly matters is the ongoing, predictable revenue from high-margin services like the App Store, Apple Music, iCloud, and Apple TV+. This services division is the silent powerhouse, a recurring revenue engine that makes Apple less a cyclical hardware company and more a subscription-based fortress. This is the part of the Apple story that doesn't get the headlines but provides the stability and growth that analysts and large-scale investors crave. It's a fundamental shift in the business model that a lot of retail investors, particularly those using investing sites for quick trades, often miss. Apple's business model is a masterpiece of vertical integration and ecosystem control. The company designs and develops its own hardware, software, and services, creating a seamless, intuitive experience that encourages user loyalty and retention. This stickiness is Apple's greatest asset. Once a consumer is in the ecosystem, using an iPhone, a Mac, and an Apple Watch, the cost and friction of leaving are incredibly high. The iPhone remains the anchor, accounting for over 50% of the company's revenue, but the services arm is the growth driver. This shift is crucial for understanding the future of the company and why Apple stock remains a core holding for many, from sophisticated Fidelity brokerage clients to those utilizing a SoFi Invest account. While competitors like Samsung and Google make compelling products, they lack the unified, closed-loop system that Apple has perfected. The recent product launch, while underwhelming on the surface, reinforced this strategy. The new Apple Watch Ultra 3 and iPhone 17 models, with their incremental improvements, are designed to keep the existing user base engaged and encourage upgrades, further expanding the active device installed base, which now exceeds 2.35 billion. This larger base is a direct funnel for higher margin services revenue, a flywheel effect that is incredibly difficult to disrupt. Looking ahead, the future outlook for Apple is a battleground of competing narratives. The expectation is that macroeconomic headwinds, particularly in the crucial Chinese market, and regulatory pressures on the App Store will heavily weigh on the stock. The reality, however, is more complex and nuanced. On one hand, yes, there are genuine risks. The company is facing increasing competition from local brands in China and the threat of antitrust legislation globally. A potential change to the App Store's revenue-sharing model could impact a significant high-margin revenue stream. But on the other hand, there are powerful catalysts waiting in the wings. Apple is pouring immense resources into artificial intelligence and augmented reality. The whispers of a new AR/VR headset, long rumored and now more concrete than ever before, represents the potential for a new product category that could redefine the entire consumer technology landscape, much like the original iPhone did. The company's in-house silicon development, from the A-series chips to the upcoming C1X modem, reduces its reliance on third-party suppliers, improving margins and control. The company's future growth hinges less on a single supercycle and more on its ability to incrementally innovate while leveraging its immense ecosystem. The introduction of Apple Intelligence, its new suite of AI features, is a critical step in this evolution, even if the initial rollout seems conservative compared to rivals. This is about making its devices more essential, more intuitive, and more deeply integrated into our lives. The long-term play for Apple is not a high-risk, high-reward bet like Tesla stock or Nvidia stock might be. It's a core, foundational position in a diversified portfolio, the kind of steady anchor you'd find in a Schwab Intelligent Portfolios or a Fidelity Mutual Funds. It's about stability, predictable cash flow, and a business model that is a fortress against competition. The company's return on equity is astronomical, and its ability to generate free cash flow is unparalleled. These aren't the metrics of a company in decline, they are the hallmarks of a titan in transition. The market's fixation on daily headlines and incremental product updates is a classic example of missing the forest for the trees. The real story is the inexorable shift towards a services-led model, a trend that will continue to drive revenue and profitability for years to come, regardless of what the latest iPhone looks like. It's this reality that creates the opportunity for long-term investors. Do you think the market is overreacting to Apple's recent product launch, or do you believe this is the beginning of a prolonged period of underperformance? Comment below and let's discuss. The company's ability to navigate geopolitical and regulatory headwinds while continuing to innovate its core products and expand its high-margin services will be the ultimate determinant of its stock performance. This is the true test of Apple. Can it continue to leverage its unshakable brand loyalty and ecosystem dominance to sustain its premium valuation in an increasingly challenging world? All signs point to yes, but the journey will be anything but quiet.